Kaushal, please start the video.
Hello, good evening, everyone.
Hi,
Welcome.
good evening, everyone. Yes, Sanita, what
Yeah,
are you doing today in the Shastrarth?
I'm first welcoming everyone to the sixth Shastrarth that we are having today. And
What do the Shastras hold for people?
okay, Shastrarth, we came up with this concept actually to make this an interactive discussion wherein we are dealing with new regulatory changes and the various questions or concerns pertaining to these circulars we are discussing over here. And
ये तो शास्त्र नहीं हो गया, शस्त्र हो गया. Go ahead. What's the plan for today? Are we going to start with two things? Number one, the floating rate reflection on the EMIs, that is an interest rate change. What do the EMIs do? Do the EMIs remain constant, that tenure gets elongated, or can we just increase the EMI? Can we do it partly this way, partly that way? That's one 18th August circular. That's part one. Part two is the penalties instead of penal interest or additional or overdue interest, because the RBI says penalties is penalty. It's not a way of earning money. It's not a cash cow. And therefore, you distinguish between interest and penalties. In what order do we take these two? My suggestion is that I believe a lot of our participants are housing finance companies for whom the EMI related or the interest rate related change of EMIs is very important. Therefore, we can take up that first. And then we focus on the penalties, which of course is important for everyone, including bankers. So talking about quick overview of the EMI variation based on interest rates. The common phenomenon with housing finance companies particularly, but this is relevant for loans against properties, housing finance companies, auto loans, etc. However, as far as the 18th August circular is concerned, it's relevant only for personal loans. Personal loans in turn include consumer credit, and consumer credit includes credit other than for business purposes. Therefore, home loans are included. LAP, if it's given for business purposes, will not be included. I repeat that for benefit of everyone. LAP, if it is given for business purpose, and to my understanding, most LAP is given for business purpose. So if you're talking about MSME loans, SME loans, small business loans, loans against properties which are for a working capital, etc., these are not intended to be covered by the RBI circular because it's very specifically directed towards consumer credit. Home loans, of course, will be very clearly covered. Car loans, once again, if the car is a personal use car, which most auto loan transactions typically would be, will also be covered. However, in case of car loans, the term is not all that long. It's 3 years, 4 years after all. So the speed with which EMI change or the level of tenure is not all that pronounced in case of car loans, though the difficulty may be there in case of car loans as well. So in terms of scope of coverage, let's first understand covers home loans for sure. Corporate finance definitely not, because if the loan is given to a company or business entity, we are very clearly out of the scope of circular. If it's a LAP given for business purposes, we're once again out. If it's a non-EMI based transaction, say loans against shares, which is typically not repaid in form of EMIs, normally it's repaid by selling the shares and paying it in one single go, that also will not be covered. Demand loans will not be covered. So these are non-EMI based transactions not covered. EMI based transactions are covered. And what is covered is only personal finance, that is consumer credit, and not business finance. That's part one. Part two,
But what about gold loans? You did not mention gold loans.
gold loans also, to my mind, mostly will not be EMI based. If the gold loans are partly EMI based and partly, let's say, bullet repaid loans, if there is an EMI, because wherever there's an interest rate change. Now the question once again would be gold loans. Are they fixed rate loans or floating loans? So I think let's basically put three basic conditions for applicability of the circular. Number one, the loan must be a floating rate loan. That would mean the rate of interest changes during the term of loan can be reflected on the existing loan transaction. We are able to pass on, we are able to percolate down the impact of interest rate changes on the loan. That's condition number one. Condition number two, the loan in question should be personal finance and not business finance. Therefore, in case of gold loans, it's mostly personal finance. But the question is it a fixed rate loan or floating rate loan? And the third question, the loan is EMI based loan. If the loan is partly EMI based and partly, let's say, a balloon repayment loan, for example, 20, 20, 30, 40% of the loan will be paid at the end, but there are EMIs in between. In my understanding, the circular will still be applicable. If the loan has a partial moratorium period, that also does not mean the circular is not applicable. That is, the circular will continue to apply in that case as well. So keep in mind, wherever interest rate change which can be reflected on the EMIs, that's where the circular applies, as long as the loan in question is for personal purposes. That's the scope of applicability. Now, as of now, the practice mostly in case of most of the housing finance transactions is to leave the EMI unchanged and elongate or contract the term to reflect the changes in interest rates. Well, interest rates could go up, interest rates could come down as well. We are not necessarily talking about interest rates going up. It might include interest rates coming down too. But what most HFCs typically do, most banks in mortgage lending do, is not to play with the EMIs, because that leads to a whole lot of logistic difficulties. We would have probably got a standing instruction, we got a lash, we might probably have PDCs. So not to leave the, not to affect or not to impact the EMIs, the adjustment is done by elongating the term in case of interest rate having gone up, or contract the term in case of EMIs having come down. Now the RBI says you necessarily give as many as 6 options when the interest rate changes. I'm talking about 6 because that's a sort of, we need to absorb the RBI circular to leave these 6 changes. And the 7th option would be, what if the borrower does not respond at all? In that case, which option do I select? That I would say is the 7th choice. But let's talk about the 6th. Number one, as interest rates change, they go up or go down. Number one, I have the option of A, increasing or varying the EMIs. That is, the borrower may choose to say that I would like my EMIs to be changed instead of changing the term. That's part one. Part two, I would say I would let the EMIs remain the same. I would want the tenure to be changed. Third, I can do partly by EMIs, partly by tenure. That's option number 3. Option number 4, I can choose to prepay the loan completely. I would say I'm not happy with the interest rate change. It's going beyond my capacity. I would like to prepay. What I, of course, need to understand is that if I have to pay the EMIs only, paying the loan entirely would be quite a tough target. Nevertheless, the RBI wants the consumer to have the option of a prepayment as well. I can also do a curtailment, partial prepayment, which is a very important option. Mostly that option is there in loan contracts, but to make it absolutely fair for the borrower may choose to partly prepay or curtail the obligation by paying a substantial, or let's say a certain chunk. Now, here comes the question, can we put a limit and say minimum prepayment should be as X%? I would think that's most reasonable, because saying you just pay 1,000 when the loan outstanding is 1 lakh, actually you could probably put a reasonable amount as the minimum prepayment, minimum partial prepayment in case of prepayment. That's option number 5. Option number 6, which is where the pain would lie, is to allow the borrower to switch from a floating rate option to a fixed rate option. Currently, most of the housing finance transactions in the country, they barely have a fixed rate option at all. Our data that we studied reveals that roughly 97% of home loan transactions in the country are based on floating rate. And I did some bit of personal inquiries with people as well, veterans in housing finance, that told me that while technically we still provide a fixed rate option, but the pricing of the fixed rate equivalent is done so high that's almost like ruling out the option. And I asked, how do you price that? They said basically we price it at the higher end of the yield curve. That is, if I got a yield curve showing a slope that 10 years rate of interest as shown by government treasury is, say, for example, 8%. So I derive the slope of the yield curve and then do a bootstrapping exercise to find the rate of interest reflected by the yield curve in, let's say, from year 7 to year 8 to year 10. So that would be even higher than the slope of the yield curve. Slope is aggregation of all the slopes. But there is a slope from year 1 to 2, there's slope from year 2 to 3, there's slope from year 3 to 4. What we see is the slope of year 1 to year 10. That's like a assimilation of all the slopes. So if I do a bootstrapping to find the slope in year 8 to 10, that is the rate that we pick up and we say the fixed rate option is as follows. And we did a little bit of checking of the rates of interest charged by some HFCs on fixed rate basis. We found the differential is as high as 5%, 500 basis points. If you take a floating rate loan, I'll charge you 9%. If you choose to go for a fixed rate loan, I'll charge you 14%, which is virtually saying that that option is not an option at all. So, but now the RBI mandatorily requires every long-term personal finance lender to provide a fixed rate option as well. And that fixed rate option, like the floating rate option, has to come from a policy. The moment you make it policy driven, will it be open for an HFC to come and say that I'll charge a crazy rate for the fixed rate option, because that option is actually a part of the policy and is a part of the borrower's statutory option. So that's the sixth option that I can choose to switch from a floating rate to a fixed rate option, which also has to be practical. It has to be reasonable, commercially consumable. It has to be reasonable, consumable option, not just a make believe, a sort of technical option by pricing it out completely. And then the seventh option of, well, if the borrower remains silent, which one do I take as the borrower's default choice? That's the seventh option that probably the HFC in question can decide that if the borrower is not choosing either of these, what's our default choice? For the switchover, they can well be a switchover charge. There may be a limit, as I cannot, for example, keep like ping ponging between floating to fixed and fixed to floating every time I find a rate change. The borrower's choice may be limited, let's say, to 1 or 2 times. I think reasonably 2. I've changed from floating to fixed, and then maybe I can turn back from fixed to floating, but doing it so very often is like I say in my dialectical language, जूता खाएंगे कि प्याज खाएंगे, तो ultimately जूता और प्याज दोनों खा जाता है. So that's a dilemma which I would think I would not like the borrower to be put in a dilemma. Therefore, keep the choice limited. That's the EMI circular. Now, on this EMI circular, there were a whole lot of questions, and as we continued exploring, we found that this is an extremely enigmatic thing. So, Anita, why don't we think in terms of what are the practical questions that people would face?
Yes, I think first of all, in terms of the applicability, since we've already discussed the kind of loans that will be covered under this particular circular, if I have to ask you, maybe move one step uh, before and ask you what all entities will actually be covered over here. So why is it relevant only because you mentioned housing finance companies are participants today, but apart from housing finance company, which all entities will be covered? It will be
I think you could probably ramp up that list, because I think that all regulated lenders are covered. So commercial
right. So
banks.
it will be covering all commercial banks, cooperative banks, NBFCs, HFCs, and everyone who is into lending will be covered over here. Now, moving to the next part of the question, wherein we discussed about the applicability in terms of which all loans are getting covered. What will be the immediate actionable over here? Because everyone will be wanting to know what is the applicability of these guidelines, or when do I need to take these steps to maybe implement these guidelines. So what is the applicability and what are the steps that we need to take to...
So unlike the penalty circular, for which there is some bit of headroom still, we still have some room to prepare ourselves and maybe implement the change. I think for some of our fintech type entities, it would probably, they'll get plenty of time. Their loans also will get over by the time the circular becomes effective. But for the interest rate variation circular of 18th August, the timeline is end of December, 31st December. You need to implement it both for existing loans as also for new loans. I'm repeating that for benefit of everyone. So remember, this is going to be implemented not just for new loans, for existing loans also. You need to implement it by 31st December. That would mean any new loan given on or after 1st January 2024 will anyway be compliant with RBI circular, but even the existing loans, you need to do whatever needs to be done to make the existing loans also compliant with the circle. That is actually leaving us, I mean, almost practically 4 months, and 4 months will be quite a narrow time, quite a tight timeline, because we are talking in terms of quite a lot of work. So let's understand what is the work. First of all, these 6 options we talked about. A, there has to be organizational philosophy in terms of pricing a loan at a fixed rate. Currently, we are pricing it based on floating rate. Most of the NBFCs, HFCs, or banks are not prepared to take interest rate risk. Remember, the big question basically is interest rate risk, absorption of interest rate risk. If we price the loan on a floating rate basis, we are pricing the interest rate risk to the consumer, saying we will not bother about it. As and when interest rates change, the risk is yours. Now, quite often argue, and I've extensively commented on this earlier as well, that between a sophisticated financial institution which has all the means and all the arsenal in its control to manage interest rate risk versus expecting a lay consumer to manage interest rate risk, बेचारा consumer जो एक salary earner है, उसको
Hmm.
बोलना कि interest rate changes go to you, it's your worry. अरे वो कैसे manage करेगा? आप तो financial sector entity, you probably have all the means, you probably have all the sophistication. So why don't you tackle the interest rate risk? Unlike, therefore, Indian scenario where 97% loans are floating rate loans, most home lending elsewhere in the world, think of US, I think 70 to 80% of home loans are fixed rate loans. Financial institutions manage risk. So question here, interest rate risk, if we are talking about a philosophy where we will, I mean, allow the switchover option. If we are talking about a switchover option, it would probably be counterintuitive to say that only when interest rates change, I'll give the option of moving from floating to fixed. It probably becomes logical that even now, when the loan is being originated, at that stage also you have practical option of either choosing fixed or choosing floating. It would be unnatural to argue that that option becomes available only when interest rate change. आज के दिन क्या गलती किया मैंने? Why would I not be able to choose a fixed rate option today? So number one, organization wide philosophy in terms of pricing and interest rate risk, and therefore creating those capabilities. That capability is not a rocket science, because essentially what, like interest rate swaps is a way of managing interest rate risk. Converting a floating rate into a fixed rate is also a way of managing interest rate risk. So that is not something which is rocket science, particularly for this country, which has substantial technical expertise in pricing this sort of interest rate changes. So number one, organizationally, we need to be ready to offer fixed rate loans. That's part one. And that requires a whole lot of work by the pricing team, including the, the quants within the company to be able to price from floating rate to fixed, taking a view on the yield curve, taking a view on forward changes in interest rates, computing that all into a spread so that from floating you can move to fixed rate. That's part one. Part two, currently your MIS systems are not designed to offer each of these 6 options you talked about. So there is a EM system change as well. For most entities, reflecting changes on the system, a loan management system, is, I'm sure, a huge exercise, and we have talking about a timeline of barely 4 months. So that's another very important, significant work to be done. Third, you need to have policy in place. And then, of course, you need to also decide what kind of documentation. We are not meaning to say that we'll send out revised agreements to all the borrowers to be sent by them. No one is thinking in terms of doing a fresh documentation. So it probably would be one-way communication. It's like an option given to borrower. The one option is coming from a regulatory change. I can probably say I'll send a supplement and say this is what is deemed inserted now. And this insertion is coming by way of a regulatory change. Therefore, I don't need to wait for signatures of the borrower. Nevertheless, I need to make what are the requisite changes in the documentation, including the EMI schedule, so to say. Lastly, I think need to think in terms of borrower communication. By December, I must have implemented it. That would mean we need to decide how to communicate this change to the borrowers. So these are very significant things to be done. For people who are sitting with few lakhs of loans, it's quite a tough, humongous exercise. And the timeline of includes the pujas and Diwalis as well, will therefore keep you all busy. So, well, while we feel for you all, but there's a lot of work to be done. I'm sure participants here are realizing that they have a mammoth task in front of them, but you need to start working on it, Anita.
Yeah, so I think one point that you mentioned with respect to communication and disclosures. Now, communication and disclosures, it will not just be for new loans, but it will also be for existing loans. For new loans, we do understand that at the time of sanction, you need to maybe update the or inform the borrower about what will be the impact of this kind of a change in case it happens, the change in EMI or the tenure. And in case there is a reset, at that point of time, you again need to communicate the option that you have provided to the borrower. What about the existing loans? Now we have these loans running. So you are saying that there will be a one-way communication that we are doing right now. So that one-way communication will cover the options as well as the impact, both these things together.
That's what I would imagine. I mean, we'll have to probably draft it out as a communication based on a regulatory change and saying henceforth when the interest rate is not changing in December. You see, if interest rate change post December, these are the options you have, and therefore X by G clauses of the agreement would stand amended as follows. It'd probably be like insertion of changes in the agreement and then making the borrower aware of the option that he has. And if you do not choose the option, then I will choose the option for you. What is my option number 7, which is in case you remain silent, what is it that I would do?
Among one of the options that you mentioned was the switchover from floating to fixed rate. Now, is there any kind of switchover charges that the lender may charge for this? And if yes, then can the borrower challenge that the reasonability of that particular charge?
So first question, can I charge switchover charges? Of course I can, because that's coming very clear from the circular as well. In any case, as you move from fixed to floating or floating to fixed, there is substantial work involved, and therefore having a reasonable switchover charge is quite understandable. Reasonable switchover charge. Can I make it, for example, unreasonable so as to sort of deter the borrower from switching? Can I fix a switchover charge which is simply to dissuade the borrower from switching over altogether? Can I sort of make it a no-go by overpricing the switchover option? Since switchover is one of the options, and one of the options coming from the so-called fair lending based principle of the RBI. Both the circulars that we're discussing today, Anita, are both part of fair lending. RBI dictated fairness
As per
needs to
RBI.
be fairness is in the eyes of the beholder, but well, the beholder is seeing everyone. And today, good thing is that we have RBI also participating in our this particular live show. But that's exactly with all seriousness we're saying. Well, the RBI has seen it fair, and I think I would appreciate the RBI has seen this fairness. After all, you are impacting whole lot of borrowers. The big part with home lending is that because of extension of maturity of existing loans, the maturities were getting beyond your age of 66, 65. People are just about to retire or have retired already, and they got a load of EMIs still to pay. That's exactly when I needed peace in life, when I have still a burden of EMIs to carry. So what the RBI has done is absolutely appreciable, but question is, can I therefore, if it's coming from a fair lending practice, can the switchover charge be unreasonable? To my mind, it cannot. To my mind, it cannot be anything. It cannot have a lethal or penal element. It has to be reasonable charge. What is reasonable? I wouldn't be able to give a numerical answer. Reasonable is what is appropriate. Appropriate is what is proper. Proper is what is reasonable. So I'll probably continue to use vague words too, but it surely has to be reasonable. And therefore, in case someone imposes unreasonable, the question basically is that if you talk about new loans, maybe a borrower has option of choosing between X, Y, Z, etc. You'd probably say my switchover charge are, let's say, 1 lakh per switchover. Another lender probably says I'm prepared to do it much cheaper. And therefore you can switch, you can choose the lender who is giving more reasonable terms. But if you're talking about imposing switchover charges on existing loans, you actually have that ability to just borrower doesn't have a choice because he's already stuck with you with a loan. Therefore, here in case of existing loans, the pricing of that switchover, number one, the switchover pricing cannot be different in case of existing loans as opposed to what it is in case of new loans. That's part one. And part two, it has to be competitive, it has to be reasonable. Can the switchover charges be related to the amount of loan outstanding at the relevant point of time, or will it be an absolute amount, or will it be like X% of the outstanding principal? If you're talking about switchover charge, to my mind, switchover charge is more like an administrative task. It's not to, because the fixed rate option itself will price the interest rate risk. Switchover charge is not to compensate for the interest rate risk. Switchover charge is simply the administrative burden involved in switching over, and therefore, in best of my understanding, the switchover charge should be an absolute amount. Neither can it be based on X% of outstanding principal, nor can it be related to the extent to which the principal has been paid off. That is, the more mature the loan is, the less is the switchover, and the more, I mean, greener the loan is, the more is switchover. I don't think that's reasonable. That's expecting the switchover charge to create to have an inherent compensation for the interest rate risk as well. Anita, that's my take.
Since we are talking about floating rate will mean having a benchmark rate. Now, the regulations have referred to an external benchmark rate. Does that mean that the benchmark rate needs to be external, or can it be internal? Like, what will be the acceptability of internal benchmark rate? Can the borrowers even challenge if there is an internal benchmark rate on the grounds of having the lack of objectivity?
So that's a very good question. And somewhere, the RBI starts in the prefatory part of the circular. It talks about external benchmark rate. It refers to an external benchmark rate in the prefatory part. Then ultimately, when it comes to the actual operative part of the circular, it's talking about a benchmark rate, possible impact of a change in benchmark rate of interest. And then somewhere it goes to say that in case of banks which have already adopted an what you call external benchmark lending EBLR regime, para 3 says in case of loans linked to an external benchmark under the EBLR framework. The EBLR framework is, I think, somewhere 2019 or something, the RBI had come up with the EBLR framework, which allowed, I think, several options to link with a repo rate, to link with benchmark rate provided by the financial benchmark company of the RBI, etc. So various options were given in terms of external benchmark rates, but in case of non-banking, in case of banks, therefore there is no choice. The personal loans will have to be linked with EBLR. In case of NBFCs, to best of my understanding, there is nothing that compels NBFCs to choose an external external benchmark. And to my understanding, most of the HFCs and NBFCs currently use their own benchmark rates.
Right.
Anita, would you confirm that?
Yes, absolutely. Most of them have their own internal rate.
So even the circular is not leading to a change in the benchmark fixation, so to say. So you can still choose to have a benchmark rate. But can I therefore say my benchmark rate is my cost of my dinner? It includes the cost of my suit and cost of my dinner as well. I think those, I mean, benchmark rate means, once again, because it's coming from fair lending circular, the choice of benchmark rate also has to be fair. It has to be reasonable rate, which is reflecting not your cost of borrowing. Your cost of borrowing could change because of your credit rating also. It should reflect cost of interest in the economy, not cost of interest that you are paying. I hope you understand, because cost of borrowing that I am paying might depend on my credit rating. My credit rating might have gone down, and therefore I might be asked for a high rate of. I cannot pass on the lender's expectation of high rate of interest because of my credit rating having gone down. The idea basically is to pass interest rate changes in the external environment and not the interest rate changes that I have suffered because of my own follies.
So when you say cost of borrowing, changes in the cost of borrowing, if it is because the RBI has made some changes in the repo rate because of which my lender changes my borrowing, in that case I can pass it on. But it should not be that based on my credit rating or any other non-compliance or anything else, the borrowing rate has been changed. That will not be passed.
I would say changes in interest rates in the economy itself, which is of course mostly linked with the policy rates of the RBI.
Right. Okay. So I think with respect to this circular, the next question that I will have, that in case the borrower does not exercises, because you mentioned there are 6 options with the borrower. If none of these options are being exercised, because most of the time in practical situations, the concern that the NBFCs or HFCs face is that they don't receive the communication from the borrower. So if the borrower does not exercise any option, can the RE by default select one particular option to be applied in that particular case? And if that,
E-
then what will that option be?
Yes, I would completely agree that borrowers quite often, I mean, borrowers may not be responsive. Borrowers may remain irresponsive, in which case, well, you still have to choose one way. You cannot keep waiting for the borrower. You apply, allow a maximum time, X number of days from the communication. Please give your choice. If you don't give a choice, I think that communication itself might say that in case you remain silent, we would have chosen option number 1 or option number 3 for you. In other words, you would have indicated that this is the default option in case we don't hear back from you. The question is, what will that option be? Well, given the fact that most HFCs in the country are still working with floating rate option, and there again they've been comfortable with elongating the tenure instead of elongating or increasing EMIs, and therefore I guess the default option would be just extend the term and not vary the EMIs. Anita, I noted a very important question and the very basic question, because we've been talking about home loans all through. And I think among our lot of participants are housing finance companies. So I can say a very basic question which has popped up during discussion is that on what basis are we saying that this circular applies to home loans?
Okay.
Would you be able to answer that?
Yeah, sure. So, if we look at the definition that this particular circular has referred to for defining personal loan, they have referred to an RBI circular, which is there for XBRL returns. Over there, the term personal loan has been defined. Now, that term includes consumer credit, it includes loan given for housing purposes, for creation or for enhancement of any immovable property. It includes loan for investment in financial assets, education loan. All of these are a part of personal loan. Now, even consumer credit has been defined, and that is again a definition which will which includes a lot of things. It could include gold loan, it could include consumer durable loan, credit card receivables. All of these have been included under the purview of this particular circular. So even housing loans will become a part of, because home loans is nothing but a loan given for, so it is included in the definition of personal loan under the head loan given for creation or enhancement of immovable property.
And just to add that the very concern from where this entire concept erupted is because of home loans.
Right.
Because in case of home loans, was this concern coming that there is a term
Elongation of tenure
extension
without harm.
which I think uh, works very badly when it comes to working age of an individual. So the whole concern was coming from home loans. Home loans are very clearly covered. There's no doubt of that.
I think now let us, okay, last question maybe from this, and then we'll move on to the next circular, which is again very important on penal charges. The last question for this would be, you mentioned that you can change the floating rate to a fixed rate loan. Now, how do we convert that? How does that mechanism work if that option is exercised by the borrower?
So to my mind, the pricing of a floating rate versus a fixed rate loan, that is converting from floating rate to fixed rate, is the same as doing an interest rate swap, where we convert a floating rate into a fixed. Most interest rate swap by definition is one where we convert a floating rate into fixed or vice versa. Now, interest rate swap market in the country is not very active market, not active at all, I would say. There is an active market in terms of overnight index swaps, so-called OIS swaps. That's fairly active, but long-term interest rate swap market is not all that active. However, because interest rate swap is the second most frequently traded OTC derivative, and therefore the techniques for pricing and interest rate swap have been fairly well developed over time. So we're using the same technique here. The only difference here is that whereas in interest rate swap, the notional amount remains fixed all through. In case of amortizing loan, the amount of principal on which the interest rate changes will be computed continues to come down. That apart, there is an additional prepayment risk here, which is not there in case of interest rate swaps. So the methodology comes from the interest rate swap pricing method. In very brief terms, I would probably say you'll basically have to see the potential interest rate changes by bootstrapping the yield curve, looking at the future interest rates, and then arrive at a fixed rate where the present value of the floating rate leg and the present value of the fixed rate leg are both the same. The discounting rate that we typically use for discounting the fixed versus floating rate movements, or fixed versus floating rate legs, is basically a risk-free rate. So we use a risk-free rate to discount the floating interest amount. The floating interest amount will be based on future interest rate projections, which are derived from when I say bootstrapping, meaning deriving the future interest rates from the yield curve. The yield curve is available today, but the yield curve is showing what is the rate of interest for 1 year, 3 year, 5 year, 7 year, 10 year as of now. From there, we're finding what is the interest rate between year 3 and 5. What is the interest rate between year 5 and 10? What's the interest rate between year 7 and 10? So we are bootstrapping or computing the interest rates in future, and we're therefore computing the floating rate cash flows from the projected interest rate scenarios, and then we are trying to work out a fixed rate which would equate the present value of the floating rate leg and the fixed rate leg. This is, I would say, in short, the methodology. Mathematically little initiated technique, but not very not a rocket science for this country, which is substantial mathematical strength,
But
particularly with what.
do I sit with computing this kind of a conversion every time there's the borrower exercises this option, or do I have this table being a part of my policy itself, wherein I can determine against which floating rate what will be the fixed rate?
So that's a very good question. So if you're saying that if we give the borrower the option of switching over from floating rate to fixed rate, will I be able to tell him now that if interest rate changes, let's say in 2024, your fixed rate will be as no way. Because I don't know now what will the interest rate in 2024 be. The question of therefore saying what's the fixed rate equivalent of that floating rate, the question does not arise. However, today if I'm charging a floating rate of let's say 9%, what's the equivalent fixed rate? So if I'm able to convert a floating rate into a fixed rate now, I'll probably therefore say whatever will be the fixed rate equivalent of the floating rate that prevails after the interest rate change. Interest rate changes from 9 to 10. So what is the what is the impact of that on the fixed rate as priced at that time? Because like I mentioned earlier, my understanding is that parallelly all long-term lenders will need to price both a floating rate option and a fixed rate option parallel. They need to give that option even now, as they will continue to give it in future as well.
Right. Okay. Then this becomes an additional task to be there in the policy as well.
Quite a significant task. And Anita, I think all the participants who are participating live on a YouTube, I would request if you have question that you like to throw for on the EMI part, on the interest rate variation versus EMI part. If you have questions, please do put the questions now before we move to the other part, which is the penalties. Anita, in the meantime, have you got any other question that you like to deal with?
Maybe one more question which will be significant over here, since a lot of our a lot of the lenders right now today are into securitization or direct assignment. If the loan in question has been securitized or it has been assigned to a third party,
Mm.
can each of these options be given to such borrowers as well?
So that's a very important question. A lot of loans would have either been securitized or would have been directly assigned under DA transactions, or might have probably been done under co-lending arrangement. So will each of these options, the options are to be given in case of loans which have been securitized, loans which have been assigned, or loans which have been co-lent. My answer to each of these questions will be yes. The options, because you cannot put a borrower to a prejudice. These very questions came during the COVID time as well, where there was a COVID mandated and the people asked same question: do I have to restructure a securitized loan, assigned loan? The answer was very clearly yes. You might need to go back to your trustees. I mean, bring them into confidence. That's between you and your trustees. But you can't put a borrower to any kind of a prejudice merely because the loan was not. He was not a party to the assignment. You were signed without. I mean, it was, let's say, notice to him. So in no way can the borrower be put to any prejudice if there is a right that accrues to a borrower whose loan has not been assigned. That very right is applicable to a borrower whose loan has been assigned as well. So in each of these three cases, securitization, D as well as co-lending, the reflection of the change will have to be given on all the loans. Question is, as you And to my mind, this is actually not a voluntary, change. It's a change which is coming because of regulations. I can probably just say that I don't need to consult anyone. I don't need to go to trustees, etc. Though my recollection is that during securitization restructuring, which is also regulatory mandated restructuring, I think a lot of companies had, I think, had to convince the trustees. Trustees had to be uh, agree in writing, but that's not my view. But if you need to talk to your trustees, make them agree to this, well, you need to do that. But in any case, the change will have to be implemented on all existing loans, even if the same are securitized or assigned. But in the meantime, Anita, I can also see a very interesting question that will this change in the loan, will it be taken as a modification of the loan? And therefore, will it require computation of a modification gain or modification loss in terms of Ind AS 109? We are not, I mean, we are not modifying, the loan EMIs. It's not modification in the sense of restructure. It's not a restructure. The word modification as used in Ind AS 109 is same as restructure. This is not a restructuring of the loan. And if interest rates change, they change across board for all the borrowers. And the resulting choice of the borrower is also not a case of restructuring. So neither the exercise of one of the 6 options by the borrower is a case of modification, nor is the reflection of a regulatory change a case of modification. So to my mind, neither of these will result into any modification exercise, and therefore the question of any gain or loss on loan modification, in my mind, doesn't arise.
There's another question on the chat which says that does the RBI want the borrowers to switch to fixed rate? Is it encouraging fixed rate loans? If yes, why RBI is doing so?
And like I mentioned, not this. There are both arguments on both sides. Some people advocate that fixed rate lending is good for borrowers. Some people argue that floating rate lending is good for the borrowers. There's a macroeconomic argument that if lending is floating rate and the RBI changes interest rates, what's the intent of the RBI? The intent of the RBI is to squeeze the liquidity in the system. So if what happens, the bankers absorb the risk because the bankers are lending on a fixed rate basis, the impact is not faced by the consumers. The consumers are unimpacted. Therefore, the entire squeeze happens at bankers level. And therefore, if we have a regime of fixed rate lending, it reduces the efficiency of a regulatory interest rate change. That's one argument. But the other argument, which I think is even more important from point of view of fairness of lending, is that how do we expect a lay consumer who is a salary earner to start paying a higher amount because interest rate, the RBI is revised interest rates. Sorry, RBI revised kiya, to you are a financial institution. I think you have all the arsenal. You can do interest rate swap, you can do interest rate hedge, you can do a uh, forward rate transaction. You know much better to manage interest rate risk than expect a lay consumer to manage it. And therefore, well, RBI doesn't necessarily want people to move from fixed rate to floating rate. Sorry, floating to fixed rate. But currently, the fixed rate option is purely a lip service. It's not. There's hardly a fixed rate option at all. That is not a very happy situation. There should be a meaningful fix. You can price a fixed rate loan, but the pricing should be meaningful pricing. It's not simply to price it out so as to make the fixed rate option completely redundant.
Okay, then let us move to the next topic, which is charging of penal charges.
And that's a
So,
very important circular once again.
yes.
It's a, I mean, initially we thought बहुत छोटा सा बात है, पहले आर्मी बोल चुका है इस बात को, तो it's nothing, कोई nuance ज्यादा नहीं है. We thought it's quite simple, 10 मिनट में खत्म कर देंगे. But as we started exploring that, and the moment we get into GST issues and accounting issues, etc., the whole thing continued getting more and more complicated. And you'll probably see that we will have a lot of nuance as we talk about the impact of the penalty circular. Let's first state it very briefly. And Anita, you could probably talk about the applicability. When does it become applicable? But I'll just briefly say very simply, it's quite simple. As of now, people are using penalty as a way of earning money. The loan is not paid in time. The EMIs are not paid in time. Whether this is applicable both for EMI or not, it's applicable to EMI, non-EMI, it's applicable to all kinds of loans. So that distinction is not there here. But the loan or loan EMIs are not paid in time, and we have a so-called penal rate of interest. The penal rate of interest is actually very often a substantially higher rate of interest than the original rate of interest on the loan itself. Idea is number one to deter the borrower from defaulting. But to the extent it's deterrent, its idea is to deter. Why do we call it interest? Interest is a compensation for time value of money. You're getting the interest anyway. If the rate of interest on the loan was 15%, you're getting 15% anyway. But the moment the 15 becomes 25, the additional 10 is not a compensatory interest. The additional 10 is actually a penalty. If it's a penalty, the penalty should be disclosed as penalties and not as additional interest or penal interest, so to say. So basic idea, quite simple, but then we talk about nuances, is that any amount which is not paid in time, you can impose your regular rate of interest. Let's call it regular interest, overdue interest, that is at the same rate as is applicable for the contractual payments. If the loan carries an IRR of, for example, 12%, and you charge 12% for an overdue period, that is still absolutely justified. You can call it overdue interest. You can call it interest for overdue period. Absolutely nothing wrong in it. So that overdue interest at the contractual interest rate is perfectly justified, and that can be compounded as well. But the whole idea is to compound it. If the interest was not paid, let's say it's continued from month 1 to month 2. In month 2, you'll be charging overdue, not just for what was deferred in month 1, but also for the interest on that amount. So the compounding of the overdue interest at the contractual interest rate is perfectly okay. I'm repeating that for everyone's exercise. RBI doesn't say don't charge interest for the overdue period. You can charge interest for the overdue period for sure, but charge it at the same rate as is applicable for any contractual payment. Right now comes the delay part. For delay part, you want to penalize the penalization factor will have to come in form of penalty and not penal interest or additional interest. The moment you talk about an interest, interest captures another interest. Interest पे interest लगता है, but penalty पे interest नहीं लगेगा. Penalty is penalty. Penalty will not carry, will not be compounded for the purpose of, there will be no interest on penalty, so to say. So penalty will remain like a separate amount. Interest, including interest for the overdue period, will continue to get compounded until it's settled. Penalty will continue separately, and penalty will not have an overdue interest. So number one, your key factual statements or your disclosures to borrowers should very clearly reflect what's your amount of penalty for any delayed period. Penalty need not just be for missing installment. Penalty could be for various other things. For example, penalty could be for a bounce check, or let's say bounce NASH instruction. Penalty may also be, let's say, for breach of financial covenants. If the loan has any financial covenant, let's say asset cover is breached, LTV is breached, there could be a penalty for that as well. So specify the failures for which you will lay penalty, specify the rate at which you will impose penalty. When you say specify the rate of penalty may come in various shapes, various forms. For example, penalty could be related to time. Every day of a defaulted payment will carry penalty at a particular rate, which is based on time. It could be based on time. It could be based on time and money. For how much was the amount outstanding? For example, I'll say every day you'll pay whatever percent. Let's say I've said 2% of the EMIs. You'll continue to pay me as penalty. I cannot call it penal interest. It will pay me as penalty. So it's based on number one, time. Number two, magnitude of the default. Number three, it may not be based on time or magnitude at all. For example, every time check bounces, I'll impose a penalty of 1,000 rupees. Every time a NASH instruction comes back, I'll impose a penalty of 500 rupees. That's a event-based or failure-based penalty. Likewise, for example, let's say security cover drops down. Let's say security cover drops from, say, 125% becomes 110. So I'll have one scale of penalty if it drops from 125 to 110. If it drops from 110 to 100, I'll probably have a higher penalty amount. So I can have a penalty which is related to security cover as well. So penalties, we need to now think in what all things will attract penalty. And for those all things, what will be the penalty scale? All of that will have to be pre-envisaged and clearly disclosed as a part of the key fact statements of the loan, so that there is an absolute transparency of how much penalty does the borrower face. So that's the gist of the penalty. Anita, you could probably now specify when does this change? There's a major change. So when does the change apply?
Before that, one thing you mentioned that this circular will be applicable on all loans. There is an exemption over here, which will be for credit cards and ECB or structured obligation. So that is exempted. Secondly, coming to the applicability, right? If we are talking about the applicability of a particular circular, what is the date? For the earlier circular, it was applicable. It had the necessary implementation was to be taken place by 31st December. Now, for the penal interest circular or penal charges circular, the effective date is 1st of Jan 2024. Now, this effective date is actually for new loans or in case there is renewal of existing loans, that this is the effective date. So, post 1st of January 2024, the penal charges will have to be applied or levied as per the particular circular that the RBI has issued. What about existing loans? In case of existing loans, RBI has said that you have a time up till 6 months from the effective date. So now if the effective date is 1st January, I have time till 6 months from the effective date or the next renewal or review of the loan, which in usual cases, a renewal or review is not something which is prefixed. So if there is
Except in
an
case of working capital,
except
or
in
let's
case
say
of
demand loans,
right.
it
Demand
demanded.
loan, it is mandatory to have an annual review. But
And working
apart from
capital is
that,
also typically reviewed. So working capital and demand loans apart. If it's a term loan, let's say EMI based loan, then normally there's no review or
yes. So
uh,
for those cases, the timeline is actually we have a time period till 6 months from the effective date. So that would become 30th of June. So till then, maybe we can follow the existing the existing way of applying penal interest, because the circular itself will not be effective for the existing loans.
आप ये बोलना चाहते हैं कि जितना लूटना चाहे भी लूट ले ये-
In a way, yes. But then I also want to highlight this point that since the effective date has already been notified by the company and we'll be maybe making it applicable or implementing it for new loans, there's no reason why for existing loans we should follow a different pattern. It could be the same that could be implemented from the effective date itself.
मैंने आप ये बोलना है कि no, I think the idea basically is that for existing loans you're talking about changing the terms of an existing loan which might probably have a penal interest or additional interest, and therefore that might require time, because translating or
So now,
transmitting.
if something is coming from the regulations, this is not something that I need to necessarily maybe intimate the customer also. Because if at the time of actual default or at the time of actual levy of this kind of a penalty, I can, based on the regulatory instruction from the RBI, I can decide that this, because this is in my hands to levy that kind of a penalty. So if I can maybe follow these instructions and from 1st January itself, I don't levy such penalty, it will be in the form of charges only, then that can be done.
तब तो फिर आप ये भी बोल सकते हैं नीता कि because my right to charge penalty has gone away, my right to charge penal interest has gone away,
Right.
and it's now been replaced by penalty. तो पहली बात तो ये कि what I was charging as penal interest earlier, I'll charge maybe the same thing. RBI is not saying how much. RBI of course is saying how much penalty. Penalty has to be commensurate. Penalty has to be justifiable, commensurate, proportional, and that penalties cannot be discriminatory. For example, आप corporate accounts में penalty charge करते हैं, let's say penal interest charge करता है 10%. Your regular rate of interest, let's say, increases by 10%. When it comes to consumer credit, you probably take it to 40%. So it cannot be disproportional, discriminatory. And therefore, the RBI is also making comments about how much penalty should be there. And I'm sure going forward, people will not hesitate to take NBFCs to before the ombudsman of the world for not being fair in fixation of penalties. But साथ में ये भी बात एक उठती है कि can I therefore say that now there's a regulator driven change whereby my right to arbitrarily fix penalties has been replaced by regulation disciplined penalties, so to say, and therefore I will also increase the rate of interest now on existing loans. That is surely not possible.
That should not be the case, definitely.
Right. ठीक. So you're saying पहले आप EMI वाला काम कर लीजिए 31 दिसंबर तक, उसका टाइमलाइन 31 दिसंबर है. 31 दिसंबर के बाद छुट्टी में जाने की जरूरत नहीं है, बिकॉज 1 जनवरी से इस वाले काम में लग जाए, है ना? तो आपसे लेके आने वाले 8-9 महीने तक आप काम में लगे रहिए.
Yes. Okay, now next, moving from the applicability, I think what will be important is how do we account for this penalty?
I think I would say before accounting, I would like to talk about.
GST.
I think the two are connected, but let's maybe take up GST and accounting. And GST is an extremely complicated issue. Very, very
That is
complicated.
the
Let me
reason I kept it for later because
Achha. But let me
complicated.
just talk about accounting first. And
Yes.
accounting may, or let me put it this way. I think I'll just want to once again reiterate what I mentioned. Let's say earlier for example, let's say my IRR was 12%, and for a delayed payment, I was charging say 36%. 12% was IRR. For delayed payments, I will start charging 36. So going forward, what will it be? I will still say for overdue period, I will charge 12% because 12% I will still, that's a contractual rate for anything which is not paid on time. I will still charge 12. The differential, which is 24%, that is something that now becomes a penal charge. I'm once again reiterating that no one is saying that you don't charge interest for the overdue period. That interest would still remain the contractual interest, and the differential, that is the 24%, is basically a deterrent charge, which is something that you want to like to penalize the borrower, punish the borrower for not paying in time. So that punitive or penal charge cannot be called interest anymore. It becomes a penalty. Therefore, your 36% will be split in two parts. Number one, overdue contractual rate 12%. Number two, the penal charge, which is 24%. Now, question comes here, 24% the penal charge. Would you be accruing that in your books? Now, the moment you talk about accrual, there are once again two split questions. Accrue in case of loans which are still performing, accrue in case of loans which have become non-performing. I think easier to talk about loans which have become non-performing. Non-performing mein to we stop accruing the interest itself.
Right.
Question of accruing something other than interest does not arise because you stop accruing the interest itself. So in case of NPS, I don't think I need to spend time. We can just stop accruing. It's debited to the SOA of the customer. Therefore, the SOA continues to have the load of the overdue interest as well as the penalties, but surely not in books of accounts. For loans which are still performing, I'm continuing with the accrual. So I remember my 36% erstwhile charge has now got two components: 12% overdue or 12% regular interest, 24% penal interest. The 12% regular interest for the period for which the EMIs have not been paid, should I accrue it? I'm sure I should. I definitely need to. If I don't accrue that, then my effective interest rate itself will get impacted. Therefore, there is no reason not to accrue the regular interest. That's part one. Part the 24%, the penal interest. Should I accrue that? Now that's a question of choice, and I probably think my advocacy, my advice would be that one should not accrue the penal component. Do we have a basis for saying that the penal component should not be accrued? The basis goes to Ind AS 115, which is the accounting standard for revenue recognition, and para 9E of that standard says if collectibility of an amount, the reasonable certainty of collectibility, if that is missing, then the question of accruing something does. In fact, I shouldn't accrue. It goes to say that accrual should not be done if each of the following factors, it talks about A, B, C, D, E, and E talks about a reasonable certainty of collection. So where the borrower has not even paid me the EMI, the question of saying that he will pay me the penalty, that I think is counterintuitive, and therefore I would probably say since collectibility was missing, I can probably frame a policy around that henceforth we will accrue the interest part but will not accrue the penal part. The penal part will be recognized only on actual collection. So my advice is accounting standards do permit deferring the accrual of the penalty until such time the penalty is actually collected. So if we collect it, we don't mind. I mean, we actually will take it to income. If we don't collect it, taking it to income and then creating a provision around that, that's hardly making any sense. That's the accounting part briefly put. GST part, however, is very, very complicated. Now, why is it very complicated? Because of a 2019 circular of GST. The 2019 circular is circular dated 28th of June 2019. For everyone's benefit, I'm once again repeating 28th June 2019 circular of GST, which is titled Clarification Regarding Applicability of GST on Additional Stock Penal Interest. It's a circular dedicated to additional or penal interest. This is 28th June 2019. Remember, this circular therefore uses the word additional stock penal interest. 18 अगस्त 2023 को आरबीआई ने बोल दिया कि आप penal interest और additional interest चार्ज कर ही नहीं सकते. There's nothing called penal interest or additional interest. Interest is interest. Interest के अलावा तो interest हो ही नहीं सकता. तो interest के अलावा तो आपको खाली penalty ही चार्ज करनी. तो क्वेश्चन ये उठता है कि is the GST circular of 2019 still valid? There's a strong reason to say that it's not valid because this circular goes to say that इंटरेस्ट तो इंटरेस्ट ही है, इंटरेस्ट वाले ओवर ड्यू पीरियड का हो, इंटरेस्ट पे जीएसटी नहीं है बिकॉज इंटरेस्ट इज एग्जेम्प्टेड. आप जो चार्ज कर रहे हैं वो भी इंटरेस्ट ही है, इट्स इंटरेस्ट इन अ डिफरेंट नेम and therefore there is no GST on the additional or penal interest. By regulation, if I'm not allowed to charge penal interest or additional interest, I'm allowed to charge penalty only. To my mind, that 2019 circular now, at least my upfront thinking, that's not applicable anymore because there's change of regulation. However, there's another very important GST circular. This is of 2022. This is circular number 178 by 178 by 10 by 2022 GST, 3rd August 2022. I'm repeating for the benefit of all parts. 3rd August 2022 circular of GST Ministry of Finance. And this one has a this is quite a long, it's 11-page circular, quite a long circular. It's got variety of items. It's basically on penalties only, of different types of penalties. And it's got a very thorough discussion on what's a penalty, what's consideration for supply, can a penalty be said to be consideration for supply, etc., etc. And this has a very important para, which is para 7.3. This para 7.3 says that a fine or penalty that a supplier or a banker, it's using word banker because it's in context of banks, but the same argument applies to NBFCs too. And using word supplier because after all in GST you're doing a supply. Word supplier doesn't mean I'm supplier of some, kirana material. Supplier here is because you are a GST registered person, you are a supplier of goods or supplier of services. So it says the fine or penalty that a supplier or bank imposes for dishonor of a check is a penalty imposed not for tolerating the act or situation, but a fine or penalty imposed for not tolerating, penalizing, and thereby deterring and discouraging such an act or situation. Therefore, check dishonor fine or penalty is not considered any service and not taxable. As you could see from the language, it seems that this is actually for check dishonor charges only, because it's time and again using check dishonor as the basis. But it's also saying something significant, that no one contractually says that you are right to breach your contract and therefore not pay me in time. And if you don't pay me in time, I'll charge penalty. No one says that I love my people, love my borrowers not to pay on time. I want my borrowers to pay on time. The borrowers don't pay on time, I'll impose a penalty. That's actually what? That's a kind of sort of punitive charge so that people pay on time. Consideration for supply. Supply here is a loan contract. Consideration for that supply is the interest. I'm happy if the borrower pays me interest. Borrower does not pay me interest, it causes a lot of disruption on me. It does disrupt my cash flow, disrupts my projections. It throws my P&L out of order. It raises my GNPA levels, etc. It raises my blood pressure levels as well. And therefore, I'm charging a penalty so that you don't do what you are current. It's a punishment. So for something which is punitive, punishment in nature, penalty by regulatory understanding as well, can there be a GST on penalty? 7.3, though worded for check dishonor, to my mind, the same argument can be applicable to the penalty for delayed payment as well. Because in what way are we computing the penalty? Like continuing with my example, I said I'm charging 12% for the overdue period. That's interest. Interest is anyway exempt of GST. Remaining 24, which is computed for every day that you default. What is the basis for charging that? Because you're not paid me. Every day you're causing a detriment to me, and therefore on a daily basis, I am penalizing. That penalty is not consideration for my loan. The penalty is a consideration for you, or rather, it's a I wouldn't call it it's a deterrent for you. It's a kind of onerous clause for you so that you are deterred from defaulting. So that cannot be said to be consideration for a supply. And in GST, what is taxable is consideration for a supply. This is not consideration for a supply at all. Another para which could be relevant from the same circular of 2022 is 7.1.3, which anyway says that if at all there is
So
some
7.1.6.
7.1.6, right, Anita, which says that even if there is a even if I could say that this penal penalty is actually in relation to a loan, the loan itself is, no one is saying loan is not taxable, loan is taxable. No one is saying loan itself is exempt. Loan is taxable. What is exempt is interest. So, and this is not interest because RBI says you cannot charge interest. Therefore, this is something other than interest. And why would therefore something which is not interest be exempted? To that, the argument is that if you say that the so-called penal penalty charge is partakes the character of the original supply. The original supply is loan, and the original consideration for the loan is interest, and this is therefore merging or partaking character with the interest itself, even though worded as penalty because of regulatory definition. If you say this partakes the nature of interest, then also it becomes exempt because interest itself is exempt. So in my view, because of 7.3 and 7.1.6 read together, there is a strong argument to say that even the penalty would remain exempt from GST. However, I would strongly urge that this is such a significant matter, and 31st December is not far away. From 1st January, you'll start facing GST questions. GST Council does not respond so very briskly that you could risk to remain dormant till then. So since all banks are at stake, all NBFCs are at stake, IBA and NBFC Association should take it up and have the GST Council clarify that the 2019 circular, which was earlier for additional interest or penal interest, would continue to be applicable despite the change of the regulatory treatment by the RBI. So Anita, my take is that if GST Council remains silent, I would like to rely on the 2022 circular to say that it's still not chargeable to GST. But I would very strongly urge people to join hands together to move the GST Council to get a clarification. Let not this matter be kept fluid because that's not in anyone's interest. Anita.
Okay, so I think a major part of what was the main concern of this particular circular has been addressed in terms of accounting and GST. Some minor questions, maybe operational wise also, which will be relevant to ask. Penalties can be charged only for non-compliance of material terms. That is what the RBI has stated over there. So if it is any other terms and condition, or who is the one who decides what is material?
Who decides whether to take a loan or give the loan? Do you decide or the borrower decides or both of you decide together? Obviously, the two of you decide.
Right.
So therefore, the two of you decide because this transparency has to be there at the inception itself. So two of you decide. You decide at time of giving the loan, the borrower decides at time of taking the loan whether the so-called breach for which penalty will be imposed and how much will the penalty be, whether that's commensurate, justifiable or not. As long as you're doing the disclosure and the disclosure is clear, well, both parties with open eyes are choosing to sign a contract, and therefore that this is just to say that I will charge a penalty for something which is immaterial. I think it's a contradiction. How can you probably be penalizing something for something which you yourself are saying immaterial? Can you punish people for doing immaterial breaches? I think the whole idea of penalty is something which is material, something which hurts you. You are penalizing because it hurts you. Penalty is not a source. Let's realize penalty is not a source of profit. Anita, I would like to maybe twist the question. And there's an age-old practice of not penalizing but rewarding. I might reward. Can I therefore twist the entire argument and say, can I reward someone who is performing and therefore deny the reward to someone who is not performing? And does that also therefore amount to a penalty? This practice, by the way, has been a consistent practice in the world of hire purchase for as long as I can recall, I think for 100 years, that there always has been a 1% or 2% debate at the end of the term for a customer who has performed as per the contract. So I'm not penalizing, I'm rewarding. Therefore, can someone who is rewarding a particular behavior of a customer and therefore withdraws that reward for a customer who is not behaving as per the agreed norms, can that also be said to be a penalty in disguise? Anita, what would you say first?
In my view, if I have to take a view, that if you're rewarding someone and you're saying that this is from a regulatory perspective, this should not be something that has been done to contravene with the directions, or maybe just a way out to not mention that this is not a penalty, and doing a vice versa thing.
So when
So
do you say something is a penalty?
if there is a breach of any covenant
Number
or
one, there has to be breach.
right,
The penalty has to be connected with some kind of a breach. If I say that, well, you have a time to pay your EMIs, say within 30 days, and let's say you've been paying bang on time without any delay. In that case, I'm so happy with your performance that I give a reward. So the reward is not for the withdrawal of reward is not for someone who's breached a contract. The withdrawal of reward is for someone who was not as good as someone else who was better. So I'm trying to reward performance, and therefore rewarding performance is the same like you got a best employee award, uh, which is not saying the rest of the employees have been penalized, right? So if I reward a particular borrower, a particular rung of borrowers, a particular variety of borrowers, it shouldn't be penalty in disguise. That I completely agree that it shouldn't be a penalty in disguise, and therefore the reward scheme should not be acting as if to impose a penalty. But if it's rewarding, you know, a, something which is worth rewarding, something which is actually rewarding a better performance, I think that cannot be said to be, cannot be said to be penalty in disguise. Connected questions, check bounce charges, that's a penalty for sure. Nash bounce charges is a penalty for sure.
prepayment charges.
Prepayment charge, is that a penalty? Prepayment charge is prepayment charge. Now, prepayment is also in a way it's a breach of a contract. The contract was a fixed term. A
Right.
3-year loan, a 10-year loan is a fixed term. The loan is now getting pre-closed. Prepayment is not an option. Prepayment is therefore a borrower coming before the end of the term, and therefore there is usually a prepayment charge. I wouldn't actually call it penalty because but आपका तो पैसा देके जा रहा है वो. It's not like पैसा लेके आ रहा है बेचारा वो. उसको penalty बोलना ठीक नहीं है, but prepayment charge because well prepayments mostly happen when interest rates are moved down, and therefore there is a loss in terms of mark to market rates of reinvestment rates would have come down. The prepayment charge is more justified because of downward variation of interest rates. I wouldn't call it penalty, but it's a prepayment charge, and well that also needs to be anyway clear and transparent. GST lagega nahi, that's a tough question. We would not want to take this in today's session because that by itself, looking at the 2022 circular, it's a quite complicated question whether prepayment charge may be said to be penalty, or will it be a charge other than interest, and therefore will it be chargeable to GST? I'll leave this question as far as this meeting is concerned. Leave this open. Anita.
The next question that can be relevant over here is the quantum of this penal charges. What will it be linked to? Will it be dependent on any factors? Because you did mention that it could be time based, it could be amount based, it could be failure based. Now, who is the one, like I have a policy in place, I need to adopt a policy. So will the policy drive the penal quantum of these penal charges, and for what kind of non-compliance, what will be charged? How is that to be determined?
So there is a work to be done in this. I think there are various things which might attract penalties, and therefore from the existing practice of being so very vague and so very, so very opaque about penalties, bankers and NBFCs have to think in terms of what all things will require penalty imposition and what will be the scales for each of the penalties. The scales don't come from the policy. The policy will give the overarching principles based on which companies will fix penalties. Idea of penalties, after all, is to have a penal element. Therefore, it's not compensatory. I cannot therefore relate it to what costs am I incurring. But sure enough, a borrower will compare loans also based on the penalties, which is quite, I would say it's a part of the entire deal. And therefore, as long as you're transparent and the key fact statement contains the penalties as well, The borrower can make a wise choice. He can choose you. If your penalties are reasonable, he can choose another one who is probably charging lesser penalties. So transparency is what is the critical part. And of course, proportionality, like the RBI clearly says that you cannot discriminate between different types of loans and saying one particular type of loan will attract higher penalties because ये मेरा cash cow है. That's not the way. Penalties can't be seen as cash cows. Penalties are purely deterrent. Lenders cannot bank on the borrowers. Credit card companies do. उनको तो फायदा तभी होता है borrowers credit card holders default करते हैं. Rest of lenders cannot be looking at a defaulter as a cash cow and a performer as वो तो बेचारा को पैसा दे ही नहीं रहा है मेरे को क्या करे. So I think that's the idea.
And you also mentioned about this step up kind of an interest in certain cases.
हाँ, ये this is very important. I think my view is still, and I know Anita that you are normally very conservative when it comes to these views. I take a little aggressive stand because very often it's very common practice once again in case of secured loans, particularly which are secured by mortgage of immovable property. It takes time to create mortgages. It might take time to take sanction of existing charge holders, etc. And it might generally take time to create a mortgage, register with the immovable property authority, etc., etc. So it's a common practice to say that if you fail to create charge, say within X number of months, say within 3 months, there'll be a step up of rate of interest. Or if the security cover drops down, security cover drops, let's say from 1.33, say it comes to 1.25, comes to 1.10, there'll be a step up of the interest rate. Is that also a penalty? Now, there could be two ways of looking at it because interest rate itself is a function of the underlying credit risk. And with a loan not being secured or not secured in time, the credit risk goes up, and therefore I'm charging the step up rate as a compensation for the credit risk and not by way of a penalty. Penalty nahi aisa baat nahi, but it's more compensatory there than a penal element. So if as long as it's compensatory because I'm taking higher risk because of breach of unavailability of security cover, and therefore if it's compensatory, I could argue that it's not penal, and therefore I can say step up interest rate based on the which is commensurate with the interest rate risk of the transaction or the credit risk of the transaction should not be viewed as a penalty. It's a complicated argument, but that's
yeah,
one
at
way.
this point, maybe I'm not fully agreeing with this view, but yes, maybe this would require a certain further discussion or work to be done on this. We have questions on the live chat as well. So I'll be reading it out for you. Are we saying penal charges to be a percentage and not a specific amount?
Now that depends on what is the penalty for. For check bounce, for example, there's no question of amount, percentage. I have check bounces, I'll charge you 500 rupees. Nash bounces, I'll charge you 300. So that's absolute amount. Penalties which are related to time for non-payment obviously will be time related. And of course, the amount related because it would be counterintuitive to say that 1 lakh rupee remains outstanding, I'll charge you whatever amount, and 1000 rupees outstanding, I'll still charge the same amount. That's counter. So it has to be both time and amount connected. Therefore, penalties may be based on a measure. The measure can be time, amount, or an event itself.
How penal charges will be reflecting in SOA if not charged in books of accounts on accrual basis?
Same as for example, NPA is non-performing interest. It shows in SOA but doesn't show in books of accounts.
Right.
SOA is different from books of accounts. Is a very well settled phenomenon.
If we simply change the nomenclature of penal interest to penalty charges with the condition that unpaid penalty interest should not be added to the principal, that would be acceptable?
Actually, we should do splitting first. Not just change nomenclature, we should split the penalty. Two parts. Number one, the overdue interest, which is anyway will accrue and will compound, and the penal part. So it's not merely renaming, it's splitting.
No, sorry. I was mentioning that overdue interest will not be the same as the rate of interest or the IRR of the loan itself.
Overdue interest has to be the same as the rate of interest, contractual rate of interest. The remaining part of the currently what is called penal rate will be the penalty amount. So mere renaming will not help.
Right. In the question, I think that they were asking is that it should not be added to the principal. That again is something that RBI
Overdue interest can be added back. Overdue interest definitely will be added and will continue to compound. So if I simply rename the today's penal charge as penalty, I am doing myself a damage because I'll not be able to compound the interest part itself.
In the scope of Ind AS 115, there are some exclusions which also cover contracts under the scope of Ind AS 109. Loans are currently covered under 109. So would 115 be applicable on loans?
Well, that's a good question. I'm this might require further working though, but I would say even if we for a minute say that 115 squarely does not apply to a financial asset which is covered by 109, but to the extent the collectability of an amount is uncertain, deferring the recognition of something which is not collectible, I think it's a sheer fundamental accrual principle. But whether we can apply the principles of 115 to a loan, particularly to the penalty part of a loan, for a minute we'll park it for further discussion. Even though the loan is covered by 109, but I think the penalty is not a part of EIR, and therefore the penalties may be to my my very upfront answer, the penalty may still be probably put under 115 because penalties are not captured by 109, but requires further working. Thanks to the queries for asking this question, very wise question, will require us to do further work. By the way, who is this querist?
The name.
Anyways, but yeah, no issues.
Do we say that GST is not applicable on prepayment or pre-closure charges as the same?
We'll not want to comment on that today. We'll like to pick it up as a separate topic. 2022 circular has given us this, fodder. We'll like to work on this fodder, consume करेंगे इसको थोड़ा, देखेंगे इसको क्या निकलता है. हो सकता है तो we might come back maybe as a separate Shastrarth on the prepayment part itself. As of now, we are just leaving the question. And for this today's event, we're leaving it open. It was not on prepayment charges anyway, so allow us the liberty of not answering it today.
Okay, the querist was our very known person, Saurav Malpani. So yes,
इतना complicated question किसको बोला? सौरभ ने पूछने का बहुत complicated question पूछा है. Anyways,
but quite relevant as well.
Very relevant.
Yeah. So I think these were the questions that we had for today, and it has been a long interaction.
Yes, it's 1 hour and 23 minutes. I think it's a fairly interesting topic. We thought that the nuances are not all that much, but we discovered that there are a lot of nuances. Participants also put extremely wise questions, and as with the rest of our events as well, people have been so very receptive at very, very short notice to join us today as in the past. So I think, Anita, you would join with me in thanking everyone. We thrive on your participation. We learn from you all. That forces us to work and do better work. So we hope we continue to do similar work with your inspiration. Thank you all for joining today. Thanks, Atal.
Thank you.